As a standalone practice, as a standing instruction kind of a practice, it's always a good thing never to average your investments, like never to average your investments. That's more from a psychological perspective, never. But then at times you feel. Now, if you feel to average, I would always suggest, averaging out seems mathematically makes sense. Your costing comes down and all those calculations.
Hello, good morning, sir.
Good evening.
Sir, why you say that you should not average?
Okay. Why I would I'll explain. Try and explain this to you. Say you had bought a stock at a certain price. Simple numbers leta hu for us to understand. You bought a stock at 100. Why did you buy the stock at 100? Because you thought it will go somewhere above 100, which will give you returns. Let's say then you bought the stock, it went a little bit, but then the stock came down. And let's say it is at 75 or 70, or let's say 85. Okay. Now, the basic idea of averaging out is you had some quantity at 100. Let's buy the same quantity at 85 or double the quantity at 85 or whatever quantity at 85. What will that do is that will take your costing down somewhere here or here, depending on the quantity you've bought. And then in the future, if you expect a bounce back, your cost has come down, you will be profitable very soon. This is the logic rationale of averaging out, which sounds fine, which sounds good. But there is one assumption and there is one psychological mistake. The assumption is you are expecting from 85 it will bounce back. This is an assumption. When that happens in the future, I will break even very quickly or maybe move into profitability. So this is an assumption, and this assumption is no different than this assumption, or let's say I'll use the better word, anticipation. The anticipation ki 85 se ghumega is very similar to the anticipation when you bought at 100. So as I said, the averaging out concept bases on the assumption. One, the assumption. Second is a psychological error. Now, where is the psychological error? The psychological error is when we bought at 100, we anticipated it will go up. Did it go up? No, it did not go up. So my reading, analysis, expectation, view on this particular stock has gone wrong once. What are the chances that I'll go right at 85? I see these two very crucial, critical points where one should never, ever average, because your reading, your analysis, what you were expecting from the stock did not deliver once. How can you deliver it? How can you expect to deliver it again, twice? Now, this averaging out, apart from this maths, wherein your costing comes lower and all that, there is a big psychological factor also, that you do not want to exit the position. Aapko 85 mein ya 90 mein bechna nahi hai, you don't want to take the loss. And so you need to feed your trade to keep your hope alive, so that you don't want to go through the pain of the loss that you are going through or you might go through in the future. Isse do cheez nikal ke aate hain. If your expectation second time was right, it bounces back, you break even, you make some profits, it's fine, you exit at a profit, done, good. But the other side of the coin, which is equally relevant and which is there all over the market, is a weak counter continues to stay weak and 85 goes to 65 and 55 and 35. You probably average 2, 3, 4 times and you're exhausted. Then you shun it, you just put it somewhere, you want to even look at it years to come. And ye sab counters sabke portfolio mein hota hi hai, I'm quite sure of it. So if I've managed to explain why I say never to average, these are the assumptions and psychological errors that we fall into.
Yeah, got it, actually got it.
Got it? The last thing that I will say is, I will never hesitate to average at a lower price if it is an instrument wherein I have very, very high degree of faith that I'm quite very close to certain that it will 100% bounce back. Where do you get this faith? Which instrument gives you that faith कि आज नहीं तो कल नहीं तो परसों नहीं तो 2 quarter बाद घूमेगा ही घूमेगा? The index. You will 100% agree with me. So if you're averaging out, if you find the stock, the index 10, 15, 5%, 50% lower, it's never a bad idea to add the index, which I mean index ETFs or index funds, whichever way you're trading index. The second best counter apart from, next to the index will be some high quality stocks. Now, this high quality again needs a little bit of understanding. High quality technically, high quality fundamentally, or high quality you're whimsically. That I leave it to you. But then if I show you my top 22 names, which is here, these are not bad names, even if they come down and you're adding them, especially in a strong down market. So never, I would say once, repeat again, never ever average out any stocks, especially these quality stocks that we discussed, like DEN and all, because आप करते ही जाएंगे, वो गिरता ही जाएगा, कब घूमेगा, who knows. But then if it's an index or some other stocks wherein, you see, if you're down 50% in DEN, the pain it gives you, and if you're, let's say, down 50% in Reliance, the pain it gives you, I think the pain that DEN gives you is much more than Reliance, because Reliance gives you that psychological support, which a DEN or any other stocks will not give you. So you need, as a trader and investor, that psychological support that the stock, your investment, your portfolio gives you. So that's my big logic of telling you why you should never, ever average.